With us on Trading Hour, will rising crude oil prices spell trouble for some of the companies that use crude as an important raw material input? Tire makers are definitely one such category of companies. In fact, stocks like JK Tyre, CEAT and Apollo, they're all up today. They're actually not reacting to that rise in oil prices, but they have seen a fall anywhere between 2 to 4% so far this month. So is some of that concern getting priced in? Rise in commodity prices and a slowdown in OEM demand perhaps can become near-term challenges. Kotak Institutional Equities has actually written a note. It's quite a cautious one on the future prospects of tire makers and tire stocks. To talk about all this and more, we have Anuj Kathuria, President of JK Tyre Industries, as well as Rishi Vora, Vice President at Kotak Institutional Equities, who's actually done that research and has written that note. So, Rishi, let me start with you. Thank you very much, both of you gentlemen, for joining in. Rishi, let's get the context out because your note really strikes a huge note of caution. You're expecting, I think, a margin compression of, 300 to 400 basis points? Just explain your thesis to us first up.
Yeah, sure. See, if you look at for the tire companies, in terms of RM basket, 50% of their overall RM cost comes from natural rubber, and another broadly 40 to 50% comes from crude derivatives. And what we have witnessed over the last, let's say 2 months, our crude from the bottoms have almost inched up by more than 20% over the last 2 months. That definitely have a lot of impact. And what we see is if crude prices obviously sustain at these levels, and also we will see an impact of 300 to 400 basis point from 1Q FY24 levels for most of the tire companies. And obviously there is an assumption that tire companies won't be hiking prices. If they do so, then obviously the impact to that extent will be minimized. But yeah, looking at the current trends in the commodity prices from 1Q levels, maybe in the coming quarters, not in second quarter, but maybe in third or fourth quarter, we may see some pressure in the margins for the tire companies.
Okay. How much have rubber prices gone up as things stand today versus the average of Q1, Rishi?
Rubber, there are two components over there. One is international rubber prices and one is the domestic natural rubber prices. Domestic natural rubber prices continues to remain steady at lower levels, whereas international rubber prices over the last 1 month have seen some uptick, predominantly because of some optimism coming out of recovery in China. So the international rubber prices have inched upwards by maybe a high single digit. The domestic natural rubber prices still continues to remain quite flattish on a QOQ basis.
Okay. Rishi, now I just want to ask you some historic perspective on this. What is the sensitivity, if you've managed to map that, between, let's say, rise in crude prices? I'm talking only crude right now. Let's leave rubber out of it. And let's say how, tire company margins behave. Is there any clear trend that can be singled out? And you just said that you're not going to be expecting price hikes to mitigate this. I mean, do you have a view on that? Then we'll ask Mr. Kathuria what he has to say.
Sure. Obviously, crude price or any commodities, if for a sector like tires, there will be a negative or a positive impact depending on the movement of commodities. And in this case, given that the crude prices have risen, what we have seen is, our sensitivity analysis suggests that like 100 bips impact on EBITDA margins have let's say 10 to 20% impact on EPS. So, if it's a 200 basis point impact on margins, then there will be like a 20 to 30% impact on EPS. So sensitivity levels are quite high. Basis the movement of commodities. In terms of the demand trends, if you look at it, let's say even if you look at 1Q results for most of the companies, the domestic demand have been like a low single digit to a flattish growth. So we are already seeing some signs of slowdown. Predominantly, one is export segment is one of the segment which is right now because of the global slowdown, it's getting impacted, and also some moderation in the OEM segment demand. And replacement select segments, especially PCR, there is some slowdown that is happening. So, in that environment where, things are slowing down, for companies to take price increases without impacting the demand, I think it would be a little challenging at the current juncture.
Okay, got that. Let's also bring Mr. Kathuria into this conversation. Mr. Kathuria, take us through how you are looking at this right now. We've been talking about this rise in crude prices, in rubber prices. What do you think this can mean for your own margins? We'll talk about demand in a bit, but first, just on the margin front, how much of an impact are you factoring in? In Q1, you were at around 12.3% for your margin. Where do you think this could go, considering that we have crude at, 92 right now?
Yeah, good morning. And, just to respond to your question, first of all, we saw that, over the last few quarters, the prices were going up. But since Q3 of last year, we saw that the commodity prices have started softening, and they have come down to a certain extent. But more importantly, when the prices were going up, we were able to pass on the increases, although at a lag in the replacement market. But in the OEM, especially in the passenger car segment, the prices are indexed with the raw material prices. However, going forward from here on, while yes, the news about the crude prices going up is correct, but we expect that these would be range bound. These are not going to behave in the manner that we saw in the previous year or the year before that. So our expectation is that the raw material prices will be more range bound. And we have also seen one more interesting aspect is that the increase in the prices for the commodities that we buy has a linkage with the crude, but there is no direct linkage. It is also a function of the overall demand and supply, the overall capacity when it comes to chemicals or say other raw material that is crude dependent. So it is not, in my view, it is not absolutely, there is no absolute correlation between crude and this. So we will have to wait and watch. But as of now, when we see Q2, we are already in the month of September, which is the last month for this quarter. The demand is holding on very well. Although there was a little bit of a slowdown, especially in the commercial vehicles from the OEMs, but replacement market demand, in fact, both for the passenger car segment as well as the commercial vehicles is good. In fact, in the small and light commercial vehicles, the demand has actually gone up significantly. And we expect that the truck and bus radial and the truck and bus bias also in the OEMs should be coming back, based on our interactions with the other OEMs. They're also expecting that the demand would revive in H2. So overall, the outlook looks quite positive. We understand that there would be certain, uncertainties. But as of now, the way we look at it, we see that the outlook is quite good.
Okay. All right, we got that. Mr. Kathuria and Rishi as well. We have a lot more questions. Please stay on for 2 minutes. We have to take a mandatory break here, but we're going to be back in just a minute and then we'll continue this conversation.
Still in conversation with Mr. Anuj Kathuria, the president of JK Tyre, and Rishi Vora of Kotak Institutional Equities. And we're just trying to ascertain the impact of rising prices, rubber prices and crude on the tyre companies' margins and what the demand is. So, Mr. Kathuria, you're saying that raw material prices, according to you, will largely be range bound. So does that mean you will be able to A, hold margins at current levels, and 2, in case there is some inflation in prices, will you be looking at taking a price hike? Is there a price hike imminent in the next 3 months?
As I mentioned earlier, the price hike will depend on how the raw material prices behave. The OE, prices are indexed with the raw material. Even we have seen that whenever there is a large or the delta is quite significant, we have been able to pass it on to the customers. It also depends on the demand in the marketplace. We see that especially in the passenger car segment and also as I mentioned, in the commercial vehicle segment, the demand is expected to be quite good and robust in the second half of this financial year. So with the demand being there, I think so if there is a need, there should be the opportunity to increase the prices. But we expect as of now that it would be more range bound.
So QOQ, Q2 average, the raw material cost for you in Q2 so far, how does it compare with Q1? Has it gone up? If yes, by how much?
We have not seen any significant change in the raw material prices in Q2 as compared to Q1.
Okay, all right, Rishi and Mr. Kathuria, thank you very much for joining in. With that, we're out of time. Leaving the markets actually looking much better. Look at the mid-cap index. There's been a sharp recovery. We were down 1% on the mid-cap index when we started the show. In the last 1 hour, that loss has been curtailed to just about 0.5% right now. So big recovery coming in. That's the 3-month chart. Today's chart we should look at because there's a recovery from the lows and the Nifty's also moved higher. That is the market for now. It's a wrap on this edition of Trading Hour. From the entire team, thank you very much for watching. But do stay tuned. Halftime report comes.